Welcome to The Drawdown, a podcast by Cherry Bekaert's private equity practice. In each episode, we explore the latest trends in the private equity sector, as well as challenges and opportunities in the ever-changing investment environment.
Welcome to The Drawdown. I'm Marci Spivey, and I lead our private client services practice here at Cherry Bekaert. In today's episode, we will discuss the quickly approaching federal estate tax quote-unquote sunset, which will be here at the end of 2025, and its implications specifically on private equity principles. I'm pleased to be joined today by my partner, Mike Kirkman, who leads our estate gift and trust group. We also have Clint Costa, Senior Wealth Strategist at Choreo, which is a wealth management firm we work with closely. Clint spent 15 years in private practice as a business advisor and estate planner before joining Choreo. At Choreo, he supports advisors and clients in advanced transfer tax, income tax, estate, and business planning matters. Mike and Clint, thanks for being here.
Thanks, Marci. Choreo appreciates the opportunity.
Always a pleasure to spend time with you, Marci.
Great. Okay, so let's just get right to it. Clint, I'm going to start with you. Can you tell us what we're talking about whenever we say the estate and gift tax quote unquote sunset and what that means?
Happy to, Marci. In general, the estate tax and the gift tax are taxes on the value of assets transferred during life or at death. But these taxes should only apply if the value of assets transferred exceeds an exemption amount. The exemption amount is set under the tax code. It's roughly $14 million per person this year and next. So how does this work? If an individual dies with less than $14 million, they shouldn't incur any estate tax. If an individual dies with more than $14 million, then the estate tax probably applies to the value of the assets above the $14 million at a 40% rate. Instead of waiting until death, individuals can make lifetime gifts under the same basic rules. The exemption is what's called unified for both kinds of transfers. Any amount of exemption used for lifetime gifts reduces the amount of exemption available at death. Okay, so now to the sunset. The sunset refers to the fact that under current law, this exemption will be cut in half after 2025. The tax code and regulations essentially say that if you use your exemption before the end of 25, you lock it in, but if not, you lose it.
Got it. Thank you. So we do know that the way the current law is written, that the estate tax exemption is set to be cut in half. However, Congress can change the law between now and the end of 2025, and particularly with the new election coming up and everybody sort of having a mix-up in Congress and in the White House. Are clients wanting to wait until after the election to do this planning? Mike, can you address that for us?
Sure, Marci. The main comment I'd make there is the wait and see approach can be so risky in several ways. First, who can predict what a new administration or Congress will do regarding tax policy? Second, time is of the essence. Even with a new administration in Congress, tax policy change doesn't happen immediately. We all know that sometimes it feels like they move at a snail's pace to get anything done anyway. Then if you do wait, you're looking for any changes that might occur, and then you're in the middle of 2025 to act on any gift planning. And the ability to get proper valuations, legal representation, and documents drafted and executed, and other major decisions around planning for this exemption amount can be difficult to finalize by the end of 2025.
I completely agree. And particularly some of the more complex planning that we see our clients do really does need to straddle 2 calendar years in order to be effective. Okay, so let's move a little bit more specifically into discussing fund managers. Clint, how does this present a planning opportunity for this group in particular?
Yeah, Marci, it all starts with the notion that successful fund managers often are or expect to become wealthy enough to have an estate tax issue, right? We don't care about estate tax if we don't think we're going to be wealthy enough to be over that exemption level that we talked about, whether it's the current exemption or the exemption that we expect to have after the sunset. And that tends to happen for many fund managers, given the nature of what they do. As a result, fund managers should be considering lifetime gift planning to minimize estate taxes in the future. The goal here is to remove high growth assets from the balance sheet before they grow. That timing aspect is hugely important because if we can remove the asset before it grows, it's not growing inside of the taxable estate that would be subject to estate tax. So generally speaking, a fund manager's LP or carried interest, they're going to start out with a lower value and grow if the fund is successful. This makes fund equity interests great potential candidates for lifetime giving. Add to these factors the historically high exemption amount and the use it or lose it deal that the sunset presents to fund managers, that all adds up to a really favorable moment through the end of 25 for fund managers to get serious about this planning.
Got it. And I completely agree. And thank you. That's helpful. Mike, Clint mentioned how we can help fund managers and how they have unique assets that we can use for planning. Can we get a little bit more specific in planning with fund managers? What kinds of challenges do they face?
Sure, Marci. First and foremost, let me just set the table with this. Private equity managers and principals and their funds are extremely complex, and they require a specialized team of professional advisors to do any type of planning regarding a particular gift or a transfer of a fund or carried interest. And I can't emphasize this enough. Working with a team of experts like the folks we have at Cherry Bekaert and Choreo's professionals like Clint in this PE space is extremely important to get things executed and properly done on the front end. But to get a little more specific, private equity transfers can be handled in a lot of different fashions. One in particular that everybody gets interested in is, hey, I want to transfer my carried interest only. And that presents some valuation issues that are deep in the Internal Revenue Code that honestly, there's a couple sides to whether you can actually transfer a carried interest and take certain discounts on the front end versus not getting any discounts at all. So that's just one aspect of just moving the carried interest. And then the other gets into what is known as vertical slice planning, where you actually transfer a percentage of everything, maybe the management company, the general partnership interest that is, and the percent of the carried interest that's associated with the GP interest. And this vehicle can be very effective, but the challenges around that are dealing with potential future needs for capital. So if you move that vertical slice into a particular vehicle like a trust, that trust is going to need to have the ability to potentially fund future capital needs. And there's some more advanced strategies around carried interest transfers that are beyond the scope of this podcast, but one in particular is and you may have heard it out there, derivative carried interest strategies. It sounds very complex, but actually it can be extremely effective given the situations and the uniqueness of private equity funds. But the important thing to remember is that there's options out there and they're available. And all PE funds have their own unique characteristics. So one planning technique may be perfect for one fund or an individual invested in one fund and not so perfect for another fund.
Thanks, Mike. That was a great overview for fund manager planning. Clint, if somebody thinks that they may need to start engaging in some estate planning, what should they do? What steps should they take?
Yeah, Marci, I think I would reiterate exactly what you and Mike have just said. It's the most important thing to do is start planning now. With the sunset scheduled to occur at the end of 25, fund managers and everyone else who's trying to do sunset planning are rapidly running out of time to engage in this planning. Right now we have the benefit of having multiple tax years to work with if assets need to be retitled or moved, in addition to just having the lead time to engage in the planning thoughtfully. Next steps might include first gathering an advisory team that is experienced with gift and estate planning For the specialized types of assets that fund managers own, namely these LP and especially the carried interests that fund managers tend to own, the team, including a CPA, wealth advisor, and attorney, needs to be able to work together to make the process manageable and not give the fund manager a second or third career in estate planning. I would say creating a financial plan is a great next step. That means establishing the balance sheet, understanding the risk profile, the financial goals, the cash flows, and the fund interest that would be subject to the gifting in the first place. The financial plan then sort of dictates the structure and the contours of a really effective estate plan. And then finally, with the right team and the financial plan in place, that customized estate and gift plan can be designed and implemented with the tax professionals and the attorney. The last point I would make on that is that fund managers engaging in this planning, they need to have that advisory team after the plan is complete. Because if the plan is successful and the assets grow, which is the sort of underlying hope of all good estate planning, there's always going to be legal, tax, financial planning, investment, compliance, all sorts of issues that are going to come up, and that fund manager is going to want to have a great team to rely on, not only for the design and the implementation, but also the maintenance of the plan through time.
Thank you, Clint. And I do know that Choreo and your team can help build that financial plan and help clients think through cash flows and help them think through their balance sheet, what it looks like now and what it should look like in the future.
That's right.
I think that does it for today. So thanks to both of you, Mike and Clint, for joining us. And thanks to all of you for listening to this episode of The Drawdown. For more information on Cherry Bekaert's estate planning services, or if you have any questions about this episode, please read our recent article, which is about the upcoming sunset, and it's published on our website at cbh.com. Until next time, take care.
Thank you for listening to The Drawdown, Cherry Bekaert's private equity podcast. The views presented by our guests do not necessarily represent the views of their respective firms. For more information on how Cherry Bekaert serves as a guide forward to private equity funds and their portfolio companies through accounting, tax, and advisory services, please visit cbh.com.